Everybody. Welcome to HAMB's webinar today featuring Deephaven. We are so excited to have them today. We're here today with Scott Searcy, your local account executive. We've got Lisa Kathy Kirkbride with Lensure, who's also your education director for HAMB. We've got Catherine Parcell with Deephaven and Tom Davis with Deephaven. Tom and Catherine, where are you coming at us from today?
I'm coming from sunny South Florida, all the way just north of the Upper Keys and about 55 miles from the Bahamas.
Wow, that sounds fun.
Yeah, I was just in Hawaii a couple of weeks ago. That was about a 14-hour trip, so that was fun and an experience.
How often do you head down to the Keys?
How
often do you head down to the Keys?
The Keys, maybe I go once every year or 2 years, but the Bahamas are only 50 miles by boat, so I can get to the Bahamas in an hour and a half.
Oh, wow.
Unlike in Hawaii, where the islands are like 50, 70, 100 miles away, some islands, like here, it's like you check in and you can go island hopping.
Oh, wow, that's awesome.
Yeah.
Catherine, where are you today?
I am coming from soon to be very chilly state of Michigan. The fall season is upon us. Our leaves are falling, getting ready for that snow. I'm about an hour north of Detroit. And fortunately, here over the Thanksgiving holiday, Tom's letting me take a vacation. He's giving me a little time off, and I'm going to be heading down to the Keys for a week over the Thanksgiving holiday. So here in Michigan, we try to get out of that cold weather a couple times during that winter season. At least I do.
Awesome. Michigan, that is a state that I have not been to. Lisa Kathy, have you been to Michigan?
I have been to Michigan, and they have really good pizza in Detroit, in Greektown.
Ooh.
And it's so good that every time I go to Detroit, I take it home with me.
and you know, we have the best Detroit style Coney hot dogs as well. We're famous for our hot dogs. So definitely, if you ever come to Michigan, you got to get a Coney dog.
Kat, you might know this. I sang karaoke at Trapper's Alley.
No. That's awesome.
That's where I know you from, Lisa.
Long time ago.
That's where I know you from. I knew I remembered you. You look so familiar. That's where I know.
Are you going to belt us out a song to start us off, Lisa Kathy?
Not unless you want everybody to log off right away.
She only knows how to sing about 9QM, so that's that, you know.
Next time.
Maybe we should write a ballad, Tom.
That's right. All right, it's about 10:03. We've got a few more people joining. We'll just give it a couple more minutes before we get started. Catherine, I love what you said about the Coney dog. I love my hot dogs with a bunch of stuff on top, tomatoes, lettuce, cilantro, you name it. I love it. It's so delicious.
That's right. We got something called a kogel. And if you're from Michigan, you're a little picky about your hot dog. You won't eat anything but a kogel. I have friends that live out of state, and if I travel by car, they're like, bring me some kogel hot dogs, Kat. They're absolutely the best, made here in Michigan, Michigan-made hot dogs.
You know, I've never had those, Kat. I'll have to try them next time I'm up that way.
Google kogel hot
dog fan too, as Judy knows.
Needless to say,
nothing beats a good LA street dog, though.
Yeah.
Oh yeah, or some LA street tacos. Oh yeah.
See, now you're making us all hungry, Judy.
Well, I have never been to Hawaii, so I'll certainly be a giver here. And if Scott needs any help, I'm happy to hop on a plane. That's for darn sure.
Yes, we'll have to change that soon, Catherine, and get you over here.
Yeah. Sure thing. I love
What about you, Scott? How's the Big Island today? How's the lava spewing?
Oh man, it's been it's been going on and off, but some of the pictures I'm seeing and videos, it's incredible. It's just absolutely incredible. Some of these fountains are coming up like 1,000 feet or so. Know somebody that was, he goes out there. There's a golf course out there in Volcano, and he said that you could, they're on the golf course and they're seeing the lava spewing up in the air, and it's not that far away, but I mean, it's far enough away. It's not going to, hurt them, but just incredible. We've got nice blue skies today in Gila, which is abnormal, so we're going to enjoy it.
Well,
Nice.
I tell you, Judy, I'll tell you, I was up at Haleakala a couple days ago at nighttime, and you can see the red glow from Big Island when it was nice and clear that night. So you can see the glow from the lava from Haleakala.
Oh, wow. That is awesome.
It's pretty cool.
Well, and then maybe that's one of the things that, for the Q&A session, we can talk about, Scott and Catherine and Tom. I actually was just trying to close a construction loan in Lava Zone 2, and the insurance was almost $10,000 per year. And of course, when we were trying to explain to everyone why it was so expensive, we had to remind everyone that active lava is shooting into the sky right now. And that will impact your insurance if you're in a lava zone. And I know that non-QM in a lava zone right now is a thing, trying to get those specialty products into a lava space. So maybe we can talk about that during our Q&A. Okay, perfect. I think that we've got enough folks joined up now that we can go ahead and get started. So for everyone on the call, welcome again to HAMB's webinar with Deephaven, Expanding Opportunities Utilizing Non-QM Mortgage Solutions, Deephaven webinar. Thank you all so much for being here today. We are with Tom Davis, Catherine Parcell, and Scott Searcy with Deephaven, and of course, Lisa Cathy Kirkbride with HAMB, and myself, Judy Meredith. Thank you all for being here with us today. Before we get started, let's talk a little bit about our sponsors. So thank you to all of our sponsors. Without you, HAMB would have a very hard time keeping you educated. So thank you all very much for your contributions and your sponsorships. We've got platinum sponsors, Freedom Mortgage, The Loan Store, PennyMac, LendSure, our webinar sponsor today, Deephaven, New Res, Decline Lending. And for gold sponsors, we have Finance Factors, Title Guarantee, Angel Oak, Accra, Advantage Credit, Foundation Mortgage, Remin, and Homes Express. And of course, our silver sponsors, Open Mortgage Wholesale, excuse me, Sierra Pacific Wholesale, Logan Finance, Cardinal Financial, and ARC Home Loans. Thank you all so much for your sponsorship. We truly, truly appreciate you. And upcoming over the next couple of months, so thank you to everyone who attended the conference as well as the Appraisal Institute Golf Tournament. I heard that those were just smashing events. So thank you to everyone for being a part of that and attending. And then, of course, next month coming up, we've got our Lenders Roundtable on November 6th, which will be at the Anaha Rooftop. For those of you that did not attend the Anaha party a couple of months ago, you really missed out, and this is your next opportunity. It is so fun, and the views are fantastic over there at Fort Village. So November 6th, 5:30 to 8:30 p.m. And then with that being said, I will give it over to Lisa Cathy. Go ahead and introduce the team.
Hi, everybody. I'm Lisa Cathy Kirkbride. We want to introduce to you the team. We have Scott Searcy here. He is your account executive, and he is located on Big Island, and he comes with a vast amount of knowledge in the industry and non-QM. And then we have Tom Davis, who is also here. He is, I'm sorry, I don't have Catherine, Kat, can you share your screen? Because
You'll
you were
need to
gonna.
give me permissions again to do that, Lisa.
Oh, I thought I did. Here you go. Sorry, yeah, because we had everything on the screen. Let me put it up so I
That's
can
all
tell you who
right.
these people are the right way
That's
instead of
okay.
trying to ad lib it
Okay.
here.
You got it. You bet. Let's get that up for you for
There
sure.
we go. So we have Tom Davis, who's our chief sales officer. He's down in Florida, basking in the sunshine down there. And then we have Kat, who is our VP business development and trainer for Deephaven, and she has so much information she's going to share with you guys today. Now we're going to let them go ahead and present. We're going to hold all questions to the end. There is a chat box with questions, and it is open, but just keep in mind we will start answering those at the end of the presentation. And without further ado, let me give you Scott.
Well, good morning, everybody. Thank you for attending. Really means a lot to us, to have you join us, hear about our products, and we hope that you'll find this information very useful. We'll share some information about the condo situation here in Honolulu, and some of the other areas out, in some of the neighboring islands, different types of situations that we might be able to handle. But I would like to hand it over to Tom Davis, who's going to kind of give us a brief market outlook, and take it away, Tom.
Yeah, so thanks everyone. Tom Davis here, Chief Sales Officer at Deephaven Mortgage. Scott, thanks for putting this together, and shout out to HAMB for putting this on and their support. Deephaven has been around since 2012. We're a pioneer in the non-QM space, help bring liquidity and introduce a lot of the products that you see in the market today. We're a back-end investor that is backed by one of the largest residential asset managers in the United States, Pretium Partners. So really strong, dependable, reliable capital in this space. So I'm going to talk to you a little bit about the overall non-agency market, right? If you look at 3 years ago, originations were, let's call it 4 trillion, a little north of 4 trillion. And we're in a market today where we'll probably do about 2 trillion. Last year, we did about 1.6 trillion. So it saw a little increase. Rates have come down. We think rates will come down marginally over the next year to a year and a half, not materially. So I think the next couple of years, it's going to be really important for originators to have access to all products in the marketplace, and to the originators that not only have access but become experts in alternative mortgage solutions will have a competitive advantage, and we're seeing that. If you look at the non-agency space, so non-agency doesn't fit agency, right? So non-agency includes non-QM, which is about $100 billion in production this year. You also have second liens. In the first half of 2025, second liens already hit over $125 billion in originations. That's going to be a bright spot, and we'll talk a little bit more about that. But also, the investor space, which accounts for over 30% of purchase transactions, that's an area that everyone should be focused on. So, and then last but not least is RTL, which is fix and flip, bridge, and construction. So if you're an originator out there, I think having access to non-QM, which is bank statement, DSCR, foreign national, let's call it the non-warrantable condo piece, different ways to qualify through income, whether it's bank statement, P&L, DSCR, those type of products, and then having access to a full suite of second liens. We're in an environment where originations, right, over the last, let's call it 15 years, everyone has all this equity's at an all-time high. And then you also have 90% of people at these lower note rates that don't plan on refinancing out of them, right? And so a lot of people are staying in their homes longer because they don't want to trade up and have a higher interest rate, higher taxes, insurance. So people are staying in their homes longer. You have a aging stock or a housing stock that's aged on average 40 to 50 years. People are going to want to renovate their homes. You're seeing that. You're seeing people want to consolidate their debt because consumer debt is at an all-time high. For example, credit card, auto loans are all north of 1 trillion, and then student loans as well. So they're going to want to consolidate their debt. People are going to want to fund their businesses, tap into their equity and fund their businesses. They're going to tap into their equity and investment properties to buy more investment properties. So second liens is going to be a big space. So I think the originators today that have all these solutions, it gives them a nice competitive advantage, and it allows them to tap into a lot of the referral partners that are in their marketplace. Outside of that, we remain bullish in the non-agency space. We think that it's going to continue to grow over the next 3 to 10 years in a big way and take on a more material piece of the market. And so if you're an originator today, I would definitely embrace, adopt these solutions and add them to your repertoire of products. So I'll pause there. I'll kick it back over to you, and let's get started on covering some products.
All right. Well, thanks everybody again for being here. As we do go through, whether it's a scenario, a general question, please put it in the chat. Your account rep there in Hawaii, Scott, is going to be monitoring that, and we'll be sure that we leave some time at the end to address that. But let's talk first about who are these borrowers, right? Who are the borrowers who are part of that $100 billion that is closing this year in that non-QM space? The largest segment of borrower utilizing the non-QM borrower is indeed the self-employed. So we're going to talk a lot today about various solutions for that self-employed borrower who likes our IRS tax code, right? Nobody goes to their accountant comes tax time and says, hey, don't deduct anything. I want to pay the most I can in April. That's not how we do things, right? We take all of our deductions, we net our income down, and sometimes that can be problematic from a debt to income structure. So we've got multiple solutions to look at that self-employed borrower from an alternative way, and we'll talk about that. The second largest group of borrowers utilizing the product base is going to be your investor. As Tom mentioned, year to date, that investor is making up 30% of the purchase market. If you look back historically, last year it was 28%, the year before was 25%. And if you look at IRS data, the investors who are claiming rental income have increased every single year over the last decade by 7.6%. So that's a big target audience for you, and non-QM can help you attract that investor. We're also going to talk a little bit about some solutions for a high net worth borrower whose employment, income, DTI may be problematic. All of the above could be a problem, but they have a heavy asset situation. There's some solutions here for that borrower. The smallest demographic of borrower utilizing the non-QM product is a credit challenge borrower. It really here at Deephaven only makes up about 3% of our total volume, but certainly we want to be well-rounded and help as many borrowers as we can. In general, when you look at the non-QM borrower, if you look at data from CoreLogic last year, they're well-heeled, well-qualified borrowers. In general, they have an average of a 700 FICO. LTV's national average is around 70. And then utilizing those alternative income features, their debt ratios are coming in at 35%. So in general, non-QM is really here to solve income, DTI, employment issues for borrowers who are well-heeled and well-qualified. We also go ahead.
Sorry to interrupt, but Hawaii is a major, military. A lot of military folks in the state of Hawaii, right? Like I think there was like 16 bases in the state of Hawaii or more potentially. But and that's the VA program is a major program there, right? Major program. If you look at non-QM, there's when you serve the self-employed, there's over 18 million self-employed people that account for over 30 million businesses, and there's also 19 million investment properties that account for 49.5 million units or doors. So if you have a VA program serving for that class of borrower or type of borrower, you should also have a program that serves self-employed people as well as investors, because there's as much, if not more, investors in the United States, and as much, if not more, self-employed folks in the United States than there's veterans. And a lot of veterans are self-employed after they get out of the military, or a lot of them become investors, right? Or they buy investment properties. So just to give you the size of the opportunity, there's a ton of self-employed people in the United States, and there's a ton of investors in the United States, and that's why these products are so important to have.
I love it when you make that point, Tom, because, I remember as an ex-loan officer myself, the first time I did a VA loan, right, I really didn't know the guidelines and how to structure that VA loan. And, once I learned it, I became the top VA loan officer in my market, and I went after the VA loans, right? So same here with non-QM, right? If you take the time to learn the ins and outs of it, just going to be secondhand the same way you do VA, FHA, and your conforming loans. And certainly we're here to assist you with that. Great point. I-10 and foreign national borrowers, that's another segment or demographic of borrower who utilize. We do have a program for the I-10 as well as that foreign national borrower. So another area to deepen the folks you can service within your community. Want to talk about some key features of the non-QM products at Deephaven, and then we'll talk about the actual product. But I think non-warrantable condos, and speaking with Scott there, who's local in Hawaii, I think this is going to be a good opportunity for you to service some of those condos that are falling outside of Fannie Freddie guidelines. So as we start talking about all of our products, our features, non-warrantable condo is going to be a big part of that. And I want to go through just a few of the key features, and then I do want Scott to talk a little bit about some of the condos there in Hawaii that he was able to close here at Deephaven. So some considerations is that commercial space. We all know Fannie and Freddie caps at 35. You can certainly go to 50 here. That vacation style rental that is operating is perhaps a short-term rental where I've got that welcome desk, the concierge desk, the cleaning services. Those are allowed. Now, we will not do, and we just always will be very upfront with you. You can count on that from Scott as he fields your scenarios. But we will not do the true condo-tel, meaning I'm owned or operated by a hotel motel. I'm connected to a hotel motel, or I have hotel motel in my name. We are not doing those, but we can carve out that vacation resort style rental that's all short term and who may be offering some of those concierge services or hotel like services, if you will. There's some flexibility on those HOA dues, up to 20%, 60 days or more past due, so slightly over that allowable for Fannie Freddie. I think one of our big carve outs on our non-warrantable is investor concentration. There's no cap. Many competitors, even in the non-QM space, will cap that investor concentration at 60, 70, right? And we know how Fannie and Freddie works. It's all based on the occupancy of the subject. Where here, it doesn't matter whether I'm dealing with a primary, a second home, or an investment property. There is absolutely zero cap on investor concentration. I could have 70 units. Every single one could be investor purposes. Litigation, that's always a hot topic when we talk about condos. And we would consider litigation that's non-structural. Now, I think the benefit here with Deephaven is if you have litigation and you're concerned about whether that is approvable or not, Scott has access to a team that can review that condo paperwork prior to you committing to the loan or originating, if you will, that loan, right? We know how that is. Once you originate a file, you got folks picking out paint colors and moving trucks and et cetera. So if you want to have us look at a condo prior to committing to that, work with Scott and he could get some eyes on that to get an opinion on whether it's doable or not. Non-warrantables do go up to 80%. I want to talk about budgets because often that is one of the reasons why your condominium is falling outside of Fannie and Freddie guidelines. It's not meeting the budgetary reserves that Fannie and Freddie set forward. Well, with our condo program, we do not have a guideline around reserves. All we ask is that you have a budget. We don't have a percentage. I know some folks in the non-QM space will reduce. Okay, I'll accept a 5% reserve or lighter than what Fannie and Freddie require, but we just don't look at that reserve at all. And I make that point because if the only reason your condo is falling outside of Fannie Freddie guides is the budget, if that is the one and only attribute making that condo non-warrantable according to Fannie and Freddie, guess what? We call it a condo. Why is that important? Because a condo, a traditional condo, would get a higher loan to value than that 80. And there's pricing differences between a non-warrantable and a condo. So often we get these files in, it's marked non-warrantable, and we're scratching our head. Well, why is it non-warrantable? Oh, well, it doesn't meet the budget requirement. Well, we don't have a budget requirement. So stressing again, if that's your only attribute, you get to run that as a traditional condo here. Master insurance is a big hot topic, as you probably know if you've dealt with condos. As many of us in the private sector has done, right? We raise our deductibles based on the rising cost of insurance, and associations are doing the same. So we will go up to 10% on that master policy deductible, exceeding the 5%. That your agency indeed allows. So quick overview of non-warrantable condos. And as we go into our products, I'll tell you the many products here at Deephaven, including a second mortgage that we have that'll support that non-warrantable. Scott, did you want to add some things perhaps pertinent to Hawaii, some things you've seen, and give some color on that for us? Maybe Scott lost
Sorry, I
audio.
had my microphone off. Okay, yeah, there's a couple of things I do want to add, actually. Hurricane insurance is also another topic. We can do less than 100% coverage, so we've done a few of those. Going to the litigation piece, yeah, we've seen a lot of condos with some litigation in it that we've been able to work around. Some of those, like Anaha is a condo that we've successfully worked on that has litigation going on currently in that project, and we've actually are able to close in that particular one. Kat, you had mentioned the condotel. We recently approved Waikiki Sunset, which really truly is a condotel, but it has enough characteristics for us to work around it. So just because it's a condotel doesn't mean that we can't do it. Let me take a look at those and see if we can, basically figure it out. Most of the time, if you present me with a scenario, first thing I'm going to want to do is go check out the project. That's generally where we're going to get stuck on something. So I have a pretty good knowledge base of a lot of these projects that are in Honolulu. I've either touched them or closed on them or whatnot. So I get pretty proficient at drilling down really quickly if this condo is going to fly or not. So the only other, a lot of times you'll see something, where the condo docs have done a special assessments. Typically, I haven't run into any that we haven't been able to do, but there might be, a hoop or two to jump through on that. We just want to make sure that the condo is not in serious trouble, so to speak. So that's a lot of things that are extra in and above her presentation. I'll just list off some of the other condos we've done: 801 South Street, Makaha Valley Tower, Park on Keamoku, and then I mentioned Waikiki Sunset. So if you have a condo that you're not sure about, my contact information you have, just shoot me over a scenario. I'll look it up. I'll let you know if we can get into these or not, okay? But that's all I got, Kat, for right now.
Well, Scott, thank you so much for that local color. And, I think that's a benefit of having Scott there and being very, very familiar with your market. And he can help you navigate through and get a pre-look on these things. So good information there, Scott. Let's talk about some key features. Let's talk first about that self-employed borrower. My net income on that tax return is problematic from a Fannie Freddie or prime jumbo status. The most popular feature is to calculate income off of 12 months of personal or business bank statements. So in lieu of the return, we're going to look at the deposits in there. Now, you all don't have to do the heavy lifting and go through all of those bank statements and try to figure out what that income is. If you send your bank statements over to Scott, generally speaking, with same day, within 24 hours at most, he's going to get back with you with what that initial income is. That indeed is the most popular feature, if you will, for that self-employed borrower. Now we have another feature that's specific to that 1099 self-employed borrower, and we do consider this a bank statement feature as well, but it's very specific to a 1099 borrower. Clearly, I could do a 12-month personal or business bank statement loan for a self-employed 1099 borrower. I'm just giving you another way to look at it. Which way works best? I don't know, but it's just all about angles, looking at each situation and deciding the best execution. With this feature, you would get last year's 1099. So I would gather my 2024 1099, just the 1099 document. You would then gather year-to-date bank statements, get them over to Scott. He'll calculate the income off of that year-to-date bank statement. It's October already. Time's flying. So I would have 9 months of bank statements. I take that 9 months of income, add it to the 12 months on the 1099, and I divide over the applicable number of months. Doing that today, it's 21 months. Now, clearly, the longer we go in the year, the more bank statements you need, right, to support that 1099. But I really want you to think about that feature as we fast approach the beginning of the year. We get our 1099 win no later than January 31st. I could come in on February 1, give you my 1099 year-to-date bank statements. In that case, it's only February. I would only need 1 month, and I would divide over 13 months. Because these are alternative income features and we're not using a tax return, there's no need to validate anything has indeed been filed. We have product on the bank statement feature as well as the 1099 bank statement feature that goes as high as a 90 LTV. But we have some lighter doc for a self-employed borrower, and it would be the 1-year P&L feature where we're utilizing net reported income off of a P&L as income. Now that comes with a lighter loan to value because it is a lighter doc. That feature might be good for a borrower who has a very complicated tax return. I have a friend of mine here in Michigan. I recommended this loan to because he owns 12 Subways, 4 Taco Bells, and a dry cleaner. Can you just imagine those tax returns? Can you imagine all those bank statements, money shifting back and forth, right? Path of least resistance for that borrower was indeed to utilize that net reported income off of that P&L. We also do have a 1-year P&L where you support the P&L with a 2-month bank statement. What's the difference? Loan to value. If I can justify the gross revenue by supporting it with a 2-month bank statement, we're going to give you a higher loan to value on that particular feature. So 2 different ways to go. Perhaps LTV may be your deciding factor. The other key feature, I think, for our self-employed alternative income is that clearly we do prefer, just like Fannie, Freddie, Prime Jumbo, every loan you do, that a borrower be self-employed for 2 years or more. But we have this guideline that said we may consider a borrower less than 2 years self-employed as long as they're 1 year or longer self-employed, and we can tie in that previous experience. So those situations, again, that's where Scott makes the difference for you. You want to run them by him because what we're really looking at is can we tie in that borrower's past experience prepared them for this self-employment. Not everybody fits into that guideline, so I would certainly run those by Scott, but I think there's an opportunity there to perhaps serve that borrower. Like an attorney. I mean, we did an attorney who, got his, passed the bar, went to work for a firm. What are they trying to do? Build their clientele or make partner within that firm. And that's what happened. He'd worked there 2.5 years, 16 months ago, made partner. So technically he's a K1 self-employed borrower now. He's doing the same thing. That was a loan that we closed. Remember, I talked about that high net worth borrower who has a heavy asset situation, who may have employment income or debt ratio issues. We call it asset utilization. Very different than what you know as Fannie and Freddie's asset depletion. This is very different. We're using the asset. They give a 6-month statement, but I mean, we use checking, savings, stocks, bonds, as well as trust accounts if they're 100% beneficiary, retirement, liquid and non. What does that mean? We're not asking you to prove terms of withdrawal. And the math is very different than Fannie and Freddie. We can use that feature to supplement other income, whether I'm doing full doc or bank statement or P&L, and I run into a debt ratio problem. Or I could qualify a borrower, no employment, no income, no DTI at all, and just look at their asset situation. So really important, I think, to look at the structure of that borrower's assets when we're trying to figure out the best solution. Some other key features, our expanded prime product doesn't limit cash in hand. Loan amounts go to 3.5 million on that. Cash out goes to 3 million. So an opportunity in your higher price market, perhaps to capture some of those cash outs. We don't look at trade lines when our primary wage earner has a 700 FICO or more. You don't have to worry about depth of credit when you're dealing with that 700 FICO. Want to talk about that investor. We know they're increasing, and give you that opportunity to represent yourself as an investment specialist, perhaps join the RIAs, right? The National Real Estate Investor Associations, some local investment groups there you may have in your local market. Good opportunity to talk to the real estate community if you understand the debt service coverage ratio program. If you're not familiar with it, it's for investment property only, no employment, no income, no DTI. We're looking solely at the cash flow of that property. We have a no ratio available. What does that mean? Well, a DSCR ratio is the calculated gross rental income on your subject divided into the PITI. So there's no minimum that borrower has to meet. Now, clearly, when I've got a borrower who cash flows and I'm covering my payment with my potential rent or current rent on a refi, the higher that DSCR ratio, the more favorable the terms are. You're going to get higher loan to values, better price point. Lower that DSCR ratio, the lower that loan to value, and the higher the loan level pricing adjustment will be. But that no ratio gives you flexibility for perhaps some of these properties that may be underwater. Long-term rents, short-term rent, both are allowed under the DSCR program. And on a long-term rent, we let you use the higher rent, either the lease or the market rent from the appraisal. That helps a lot of DSCR ratios. Interest only is the big feature for investors. They are the heavier user of interest only features. And the benefit of our DSCR product is you can qualify the borrower off of the interest only payment plus the escrows. I don't have to fully amortize that like you would with other product. So it's a benefit to that investor. Reserves are a big benefit under DSCR because it's probably the only product you can sell where your borrower does not need reserves on every single finance property they have, right? Every other loan you sell, you got to look at how many finance properties they have and calculate reserves on those finance properties. With DSCR, the reserves are based only on your subject, 3 or 6 months. It's based on loan amount and what that DSCR ratio is. And on cash out refis, that cash out will cover the reserve. So think about a DSCR investment property cash out refi. There's no employment to document, no income to document, no debt ratio to look at, and I don't even have to ask what the asset structure of my borrower is. You can see why it's very, very popular for the investor. Gift funds are allowed. I don't think we're accustomed to that. Fannie and Freddie, as long as I've been in the business, which has been a long, long time, Fannie and Freddie have never allowed gift funds on investment property. Indeed, you can get a gift when that borrower has 10% of their own money. LLCs are a big deal for your investor, whether they want to be a borrower as a natural person. Pat Parcells, my borrower, and I come to you and say, hey, can I put the deed to my property in my LLC at close? You certainly can. Or whether I am that borrower who comes to you and says, hey, I want you to make the loan to my entity. Can Cat Parcel Property Management LLC be the borrower? Yeah, we can structure it that way. One member owning 25% or more would guarantee that loan, and we'd base the credit and FICO and everything off of the guarantor. Foreign national allowed under DSCR. No trade line requirements with a 700 FICO. LTVs go up to 80 on your purchase rate and term and cash out for the DSCR loan. Second mortgages, when it comes to some key features, talking and flipping over to that second mortgage opportunity, some key features we have under our equity advantage umbrella is we can use the alternative income for that self-employed borrower. So I'm self-employed, I'm sitting on a 2.25%, 4%, whatever it may be, low interest rate on my first. I want to renovate, I want to cash out, but my net income on that tax return is problematic. Your equity advantage product goes to a 50 DTI, and I can use the bank statements in lieu of the tax return. Or I could use the 1-year P&L in lieu of a tax return. I got to have a borrower whose calculated gross rental income does cover both payments of 1 or higher DSCR. So we allow that DSCR feature on a second mortgage as well as a first. Second mortgage don't require reserves at all. So if I'm doing a second mortgage, I would not ever have to question a borrower on what their asset position is. They're not required to show assets on a second mortgage. And if I'm doing an investment property under the DSCR second mortgage, you can entertain the LLC situation, both the vesting and the borrower entity. So multitude of solutions for the investor, the self-employed borrower, the folks with high net worth who may have, or high assets, I should say, who have employment income or DTI challenges. Want to flip into products so we can leave, we'll go through this quickly so we can leave some time for some Q&A. Products that support these features. Expanded Prime has the largest amount of alternative income features. The bank statement, the 1099 plus bank statement, the assets as income, P&L only, P&L plus bank statements. All those features are available under Expanded Prime. It's our core product. We close the most under this, and it goes to $3.5 million on that loan amount. Cash out up to that $3 million, as I mentioned. DTI on a primary under this program can go as high as a 55. Second homes and investors up to that 50. Non-warrantable condos are allowed. You can use all of those alternative features. And there is a 6% allowable seller concession on that product as well. Non-prime, what if I fall below a 660 FICO? This is what I was saying runs about 3% of our volume is this particular product. Uses would be, I've got a lower FICO. I can meet that 620 minimum, or maybe I have some recent mortgage lates, or I need some lighter seasoning on bankruptcy, short sales deed, and loser foreclosures. Or maybe I'm that ITIN borrower. I live here, I work here. I don't have any legal status. I'm not a non-perm, I'm not a perm, right? I'm an I-10 borrower. They do need a higher FICO, and there are some overlays on that borrower, but we serve that borrower under this product. The alternative income features for the self-employed are going to be the bank statement or the P&L. The P&L would be supported with a 2-month bank statement under this particular product. DSCR, investment property, no employment, no income, no DTI based off of that ratio. Minimum FICO 640. Get to use the highest FICO of the borrowers. Loan amounts up to 2.5 million. Cash out up to 1 million in hand. As I mentioned, I'm doing a cash out refi for an investor. I don't have to ask about assets. I don't need assets. That cash out's going to cover that 3 or 6 month reserve. So it becomes a very light doc and very little to underwrite. Non-warrantable condos. So think about a non-warrantable condo. Investors are often the folks making the condo non-warrantable, right? So no employment, no income, no DTI, cash out, no asset, non-warrantable condo. So a lot of potential for you to go out and sell the DSCR. Both long and short-term rentals are allowed. And I can get 6% seller concessions on this product as well. You may want to expand out to the 5 to 9 unit property. We have a DSCR product that serves the 5 to 9 unit. No employment, no income, no DTI based off of the cash flow of that multi-unit 5 to 9 unit property. So DSCR ratios are 1.15 on that product. That LLC is wide open as well on the 5 to 9. This particular product would be a long-term rent situation only. The 5 to 9 is not a short-term rent play. Good opportunity, I think, to expand out to that multi-unit property. On the investor front, Deephaven has the full suite, right? Whether it's the DSCR, whether it's a borrower who has heavy assets, I'm an investor, maybe I want to do the no employment, no income, no DTI under expanded prime and not even worry about the DSCR ratio. I don't know, right? The point here being whether it's a 1 to 4, a 5 to 9, or a second mortgage, there's a full suite. And that suite also includes the residential transition loans through our sister company, Anchor. So now we can go out and serve that investment population who's the fix and flipper, right? The non-owner occupied fix and flip, or that non-owner occupied borrower who needs a bridge loan. Or maybe you want to go after your local builder who is building for the purposes of investment properties and need some help with that project. I mean, that loan goes up to $20 million on that ground up construction. So I think when you start looking at the full suite, you've got a lot that you can talk about with your investment community and serve them outside of what those traditional loans are. We've talked a lot about second mortgages, so I'll quickly explain the differences. Your second mortgage products can indeed go borrower or lender paid. So you've got that opportunity on that lender paid comp with the equity advantage products as well. The difference between the equity advantage and the equity advantage lead is this. If I have a borrower who needs an alternative income, I would go to that equity advantage, right? Where I could do the bank statement or 1 year P&L. Or maybe I've got a full doc borrower, but they're in that non-warrantable condo. The reason I'm here is because I have a non-warrantable condo. I don't know, maybe I bought the property, it was warrantable. Now I go get a second mortgage and something in that association changed and now I'm non-warrantable. I don't know. But if I were certainly in your physical shoes, whether it's your marketing team, your broker owner, you yourself, get that mailer out, get those phone calls out to your past client base. These second mortgage products are really a retention tool. You want to retain the client. Your big box servicers out there, they're hammering these folks. They know this is the growing segment of the market right now, and the need is that second mortgage. So you want to get to your borrower, retain them, and certainly be able to understand the options within the second mortgage base here. The reason I would go to the elite product, I got a full doc borrower, and they have a higher FICO, and let's say the condo's warrantable. Elite does not support the non-warrantable condo. All right, non-warrantable condo, you always want to go to equity advantage. That's the second lien product in our suite that's going to support that property type. But if I've got a condo, single family, et cetera, and I got a full doc borrower, Elite's going to give you the best price point for that higher FICO, deeper credit second mortgage borrower. That would be your use for that product. And then, of course, the debt service coverage ratio, right? Second mortgage, no employment, no income, no DTI based off of the SCR, no reserves at all required on a second mortgage. I don't have to ask about the asset situation. These second mortgage DSCR, however, is a long-term rent play. You want to be looking for your long-term rental. If you've got a short-term rental needing cash out, you would want to go over to that first lien DSCR product. Even on the second mortgage front, you can deal with the LLC and the LLC vesting. So yeah, we have a lot of resources here, but we've only got about 9 minutes left. I do want you to know where our website is. It is www.deephavenmortgage.com. There is a host of resources on our website for you. Our full matrices are there, a blended rate calculator to help you sell that second mortgage, a scenario calculator. We also have white label flyers, white label presentation deck, but your real difference maker here for you is for sure going to be Scott. Being local, understanding your market, being available to you. So look around on the website at all these tools. We also host private sessions. So we do about 80, 90 of these things a month for our clients where if you get a hold of Scott and you want to dive deep, you want to know everything about DSCR or second mortgages, or how does that bank statement loan? Well, what are you looking at on that 1-year P&L, right? How can we put this all together? We've got every feature, every product broken down into little mini sessions, educational. So whether it's one person in your office or 350 of you, we don't care. We'd love to get on with you and take some deeper dives on these products. So Scott, is there any questions there in that chat box, or anything we want to wrap up with, or you want to leave the group with?
I don't see any questions in here. I did, as you were going through the presentation, I wanted to remind everybody that we can do some blended income types. So that would be where you got one borrower that's self-employed and you got another borrower that's W-2. Yes, we can combine those incomes together to qualify. So like I said, if you have...
Scott, you could also do, if you're doing bank statement, you could also augment the bank statement with the asset utilization. So you could do that as well.
Yeah. There's a lot of different ways we can work with the blended income. So that being said, if you have any questions, shoot me an email or call me. You'll find that I'm very, very responsive. And I'll be happy to answer any of those questions or research a project for you to see if it's available or anything you may need. So thank you for having us.
Is the chat open? Because I don't know if it's even open.
I'm looking in the question box.
It is open for questions.
Okay.
Mm-hmm.
It is open for questions if somebody wants to type their questions in if they have any.
Yeah, and then while we're waiting for some of those questions to come forward, I've got a couple of questions that the group may find interesting. So, Scott, I heard you say that you were successful in closing a NAHA.
That is correct.
Wow, that is amazing, because a NAHA notoriously has structural litigation against the building, as well as many of those buildings there in Ward Village. like the Collections and the Symphony. Are you able to finance those buildings as well?
I haven't looked at those specific. I've looked specifically at an AHA, but I haven't looked at the other ones.
Okay, awesome. But just the fact that you're able to get around it and you're successful in an AHA is huge. Um, so I'll definitely keep that in mind and let my team know. That's very, very big news. Um, DSCR, no ratio is allowed. I thought that that was amazing. And then down to 640 FICO. No ratio is allowed at 640 as well, or what's the FICO requirement if we had a no ratio file?
That is a good question.
That, what's
No
the
ratio.
no?
Yep, no ratio is going to be a little bit of a higher FICO. You're going to be looking at that 680 and up bucket on that no ratio, and then you're going to have a lower FICO at 680 than you would at a 700 or 720. So when you look at your matrices, if you go to deephavenmortgage.com and we go to our website, you're going to see that matrix, and I'll see if I can get there for you. You're going to see that matrix is going to be broken down into 3 different categories. One is going to be 1 or higher DSCR. Then you're going to have a separate section under your program where it's going to be 7.5 to 9.9. And then you are going to have another section on that DSCR where it is going to be that no ratio. Now, clearly, as you get into that no ratio, your loan level pricing adjustment is going to be much higher. I mean, think about it. No employment, no income, no DTI, and I can't even meet a 3/4 ratio, meaning I can't even cover, my pity by 3/4. So you're gonna want to make sure you always are referring here, and I'll try to zoom in so you can see what I'm talking about. When you come up here, you'll see the 3 different categories that are broken down into that particular ratio. So when you see the no ratio, you'll see the break over here is 680, right? When I get to that 640, it's an NA. So that's how you're going to be reading those matrices. So long answer, but short answer is 680 for a no ratio.
Perfect. Thank you so much for that, Catherine. And
You're
then
welcome.
the other product that you brought up, second mortgage, allowing for non-warrantable condo, that is also amazing. Very few second mortgages right now will even touch a non-warrantable condo. 1.0 DSCR, is there an opportunity to get an exception below the 1.0 DSCR for the second mortgage?
I've not seen us move on that. If you think about the risk level on that, right? No employment, no income, no DTI, and I'm in second lien position. We feel more comfortable when that borrower has enough cash flow to cover both. But what I want you to keep in mind on that DSCR and DSCR in general, whether it's the first of 1 to 4, whether that's second, oftentimes, as you all well know, your borrower's collecting higher rents than what that market data comes in at, right? Especially in areas where there's shortage of opportunity or inventory. So if I've got that long-term rent, right, because remember the second mortgage is for long-term rent, and I've got a borrower whose lease agreement and he's been collecting for 3 months higher rent than what that market data comes in at on your 1007 or 1025, we let you use the higher rent. I'm telling you, if you remember that feature, it happens a lot. Maybe I come in at 0.95. Now I just go back to my borrower, get proof of receipt of that higher rent, and push my DSCR ratio where it needs to be.
Hey, one other thing too, Kat, on seconds. I know we go to a $400,000 loan amount with an AVM. We don't need an appraisal, and we'll go up to $750,000 on a max loan amount, but we do exceptions, and so we do a lot of exceptions. But I've seen loan amounts up to $1 million on closing seconds too. So
Yeah, good point. On that, and yeah, I think really, if you hear anything today, is if you have not reached out and made some warm friendly phone calls, congratulating your past clients on the equity they built and see if they have any lending needs. Someone else is gonna. The numbers just indicate the rise in the need. So, might be something you want to, get your marketing team. We have some white label flyers that Scott could send you that kind of give you some verbiage about the second mortgage if you're looking for something to do a mailer or something like that, for sure.
Awesome. Thank you so much, Tom. Thank you so much, Kat. Thank you so much, Scott, for being here with us today. I really learned a lot. I know that our attendees also did. And of course, for everyone on this call, please reach out to Scott directly. He is your boots on the ground, here to help you, guide you through the programs, help you choose the right one. And I am jazzed about these programs and what Deephaven can do. Thank you so much for sharing all of that with us today.
Excellent.
Thank you
Thanks,
for
Judy.
having us, Judy.
Thank
Thank
you
you.
again.
Have a great day, everybody.
Have a wonderful
Thank
day,
you,
everybody.
everybody.
All right.
Bye-bye.
Bye-bye.